Hi, so this is a simple funds flow statement question. Um, Before we see this particular question, let us just find out what exactly comes in a funds flow statement answer. First, you will have the funds flow statement itself. So you have the funds flow statement, which has sources and applications. Then you will have the statement of changes in working capital, that is the decrease or increase in current assets or current liabilities. And finally, we have the funds from operations. We start the funds from operations with the net profit as per the balance sheet. Okay, so let's just go back to the question. They've asked us to prepare a fund flow statement. They've given the balance sheet items for the year 2002 and 2003, and they're given the share capital, the P&L account, current liabilities, goodwill, which is an intangible asset, plant and machinery, a fixed asset, and current assets. And along with that, they've also given some additional information. It says that depreciation of 20,000 on plant and machinery was charged to profit and loss account, and dividends of rupees 12,000 were paid during the year. Now, before we get on to the answer, let us just find out what each of these statements have to do. So, I'll just show you the hints. Now, sources are basically when money comes in. Now, when your liabilities increase, that means money is coming in. When you decrease in assets, for example, when you sell a machinery, money is coming in because you sell the machinery and you get money. So all increase in liabilities, decrease in assets, anything that has got to do with money coming in, those go to sources. And it is the opposite for applications when money goes out. So when an asset increases, you buy a machinery, you're basically paying off cash. So that means money is going out. When decrease in liabilities, um, your money is going down, money is going out. So so for example, when you pay a creditor, you're paying money to him and money goes out. So then it comes to applications. And next is statement of changes in working capital. Working capital basically is the current assets minus the current liabilities. If there is an increase in current assets, then it increases the working capital, so it goes to the plus column. And if there is a decrease in current assets, it goes to the minus column. And it's the same for it's the vice versa for current liabilities. If there's an increase in current liabilities, it goes to the plus column, and if there's a decrease in current liabilities, then it goes to the minus column. And finally, the funds from operations, we basically start from the net profit which is given in the balance sheet. If you look at a P&L account, you will have all sorts of debits. You will have, say, payment of dividend, payment of depreciation. Now, depreciation, for example, is debited to the P&L. It is used while calculating the overall profit for the company, but it has got nothing to do with cash. There's no actual cash moving, so it's a non-cash debit. Depreciation is a non-cash debit. So those we will add back. It was originally subtracted to find out the overall net profit. Now we will add back. And it's the same thing for non-cash credits. For example, when you sell a machinery and you earn a profit on that particular sale, the profit is, you don't exactly receive cash. It is just a non-cash credit in the P&L, and it's added to find the overall net profit. So this time we will subtract it to find out what the cash movement from the net profit was. So keeping that in mind, let's go to the question, and we always start with the adjustments, that is the additional information. And the important thing to remember, every adjustment always affects two places. So keeping that in mind, let's go to the first adjustment. It says depreciation of 20,000 on plant and machinery was charged to P&L account. Now, plant and machinery, we have it in the balance sheet. So what we need to do is, the opening balance was in 2002 was 60,000, the closing balance is 50,000. So we need to open a plant and machinery adjustment account, or a fixed asset adjustment account. So I'll just open that here. This is a fixed assets account, and we'll put the opening balance. Fixed assets, all assets have a debit balance, so the opening balance will come on the debit side. Just type that to opening balance. That is 60,000. That is 60,000. So, excuse me. And they have the closing balance, and that is 50,000. And they've given in the adjustment that the depreciation that was charged during the year was 20,000. So depreciation on plant and machinery is credited to the machinery account. We'll just instead of fixed assets, we just make it plant and machinery account. We can see that later. Let's change it now. Plant and machinery account. And yeah, so the depreciation is credited. It lowers the plant and machinery account. So by depreciation, and that was 20,000. Okay, so now if you look at the overall account, there's a balancing figure. This side is 60,000, this side you add 20 plus 50,000, it's 70,000. So there's a balancing figure of 10,000. So the balancing figure, what will that be? The balancing figure would be, we have bought more plant and machinery, so it's increased the balance, it's increased the plant and machinery balance. So we have purchased some more, so we'll do 2 purchases for an amount of the balancing figure, that is 10,000. Okay. Now we have closed this account. This account has been closed. So let's see. We saw that adjustments affect 2 places. Okay, so the depreciation on 20,000, it's gone here. This is 1. Where else would it go? In the P&L account, it would have been debited. Now, non-cash debit, that is depreciation, it has to be added back to profit and loss. So we can just put depreciation of plant and machinery, and that would be how much did we get? 20,000. Sorry. Okay. The opening net profit as per balance sheet also we can we'll do it. I'll do it later. Okay, so 20,000. So that is done. Depreciation is done, and also we have purchases. Now purchases is actually, it's a silent adjustment. We found out that we have purchased machinery, so that goes here to this particular account. And when we buy machinery, what happens? Our assets increase, correct? And when an increase in assets happen, we pay money to get machinery, so money goes out, so it's an increase in assets. So we can enter purchase of machinery as an application, and that came to 10,000. Okay, the next adjustment is dividends. Now 12,000 were paid during the year as dividends. So when you pay dividends, the money actually is going out. So 12,000 was paid during the year, so money goes out, so it's an application again. So we can just put dividend paid, and that is to an extent of I forgot the amount, 1 second, 12,000. So we paid 12,000 as dividends. And also, as I mentioned again earlier, adjustments go to 2 places, so it goes here. Now if you look at a P&L account, we would have debited the payment of dividend. Now since I've already shown it here, we have to add it back. It would have been debited in the P&L account, but since we're showing it in fund flow statement, we have to add it back over here. So I'll just do that. Dividend paid, 12,000. Okay. Now that we are done with the adjustments, let's go to the balance sheet. The share capital. There has been an increase in share capital from 60,000 to 65,000, so that's 5,000. There's been an increase in 5,000. Increase in liabilities goes to the sources side. So I'll just type increase in share capital. Share capital of 5,000 rupees. Okay, and then what is the next item in the liability side? That is profit and loss account. In profit and loss account, it goes to the funds from operations. It's the starting of funds from operations. The balance is opening balance is 34,000, closing balance is 26,000. So if you subtract the current year 26,000 minus 34,000, you get minus 8,000. So we actually start with the loss. We start with a loss of 8,000. I'll just enter that here. Sorry. Start with a loss of 8,000. And then we come to current liabilities. Now current liabilities has gone down. 12,000 minus 3,000, it's gone down by 9,000. Decrease in current liabilities goes to plus. So a decrease in current liability is a plus. So let's just put the amount there. Excuse me. And that's 9,000. The next is, we're done with liabilities. Next is goodwill. Now goodwill is an intangible asset, and you see that it's gone down by 5,000, which basically means goodwill has been written off by 5,000 rupees. Now goodwill written off would have gone to profit and loss account. It would have been debited. So since it's written off, we actually add it back, because it's an intangible asset. There's no actual movement of money, but then it would have been debited in the P&L account. It would have been added to find out, it would have been subtracted to find out the overall net profit. So now we have to add it back. It's a non-cash debit in P&L, so we add it back. Goodwill of 5,000. And we come to plant and machinery. We've already done. We've done plant and machinery. And finally we come to current assets. There has been an increase of 3,000, 16,000 and 19,000. So 19 minus 16, that's 3. 3,000 increase in current assets. Increase in current assets again goes to the plus sign of statement of changes in working capital. The amount is 3,000. Okay, I'm sorry that it's not properly aligned. Alright. Okay, so now that we're done with the entire sum, we can go and start totaling it out. Okay, so first we have minus 8,000 plus 20,000 plus 12,000 plus 5,000. 20 plus 12 is 32,000. 32,000 plus 5,000 is 37,000, and 37,000 minus 8,000 is 29,000. So 29,000. Okay. And funds from operation basically is the profit. It's a plus, so we got funds from operations, means money, the total money that is being gained from operations. Now when money comes in, where does it go? It goes all the way to sources. Money comes in, so it goes to sources. So we can put funds from operations here, and that was 29,000. And let's come to statement of changes in working capital. the assets, the plus side is more, which basically means there has been an increase in working capital. Current assets is more, it means an increase in working capital, and that will be the balancing figure. So that is 9 plus 3, 12,000. And once we do that, this gets tallied. So an increase in working capital basically means current assets has increased. Now what happens, increase in assets means it's an application. So this will go here. So increase in working capital is 12,000. Now this fund flow statement has to tally. If it doesn't tally, the answer is wrong. So let's just check if it tallies. 5,000 plus 29,000, that is 34,000. I'm sorry for the horrible handwriting. And 10,000 plus 12,000 plus 1,200. I'm sorry, it's 12,000. Okay, got scared, it was wrong. Plus 12,000, that comes to 34,000. Right. And so it tallies, and that is the answer. I'm sorry for the horrible handwriting and the if it was difficult to understand, but I hope you understood overall how to do this sum. Thank you for watching.